How are we gearing up for Tuesday?
Yeah, this is definitely a very anticipated earnings release for Netflix. It's always an event when Netflix releases earnings, given how the stock has performed over the years. But once again, investors will be focusing on the net subscriber add number. That is really the metric that investors focus on for this name, as opposed to EPS or even revenue. It's how many subscribers did they add globally. This quarter, they're looking for about 5 million. We think that is a number that they can hit and maybe even exceed. But that is the key number. And as you mentioned, last quarter they missed on this very important metric, and the stock took a big hit on that news.
Took a beating, down 15% then. Right now the stock's been taking a beating as well. We've seen the biggest slump since 2016 in some cases for this particular stock. Citi and some analysts are now seeing opportunity when it comes to Netflix. Is it from a valuation perspective as well as underlying growth drivers?
Well, it's tough to make a valuation call per se on this name. I think, when people look at this name, they kind of have to put their valuation hat aside a little bit and really think about the global market going forward, and the fact that consumers are spending more and more of their time consuming content in a streaming fashion as opposed to the traditional pay TV window like the cable service. And so in that regard, if you think that is a global business and has a long-term growth story on a global scale, then Netflix is the name. And the story for most bullish investors is, as long as they can continue to grow their subscriber base, they can continue to increase their investment in programming, which presumably will drive even more subscriber growth going forward. So that is why the subscriber growth remains really key for this story.
125 times future earnings is where it trades at the moment. How important is it that they can still entice people in while they hike prices as well?
Yeah, the company has proven that they have pricing power. They've raised prices several times over the last couple of years and has not impacted their subscriber growth. So when you take a look at this story, one of the concerns for investors is the fact that they're spending so much on programming. This year, they will spend more than $8 billion on their P&L this year. That is up dramatically from last year, and the expectation is they will increase that spending next year. The problem is they don't have the free cash flow to support that, to fund that. In fact, the street consensus is for about a $3 billion free cash flow loss this year. So the company is financing this huge investment in programming in the debt market. Now, they can continue to do that as long as they continue to grow subscribers, improve profitability, and ultimately get the positive free cash flow so that this can become a self-supporting business.